Hi, I'm Gary Paulin, Head of International Enterprise Client Solutions at Northern Trust. I'm delighted to be joined by Stephen Yiu, CIO of Blue Whale Growth Fund, and Freddie Lait, the Managing Partner at Latitude Investment Management, for our latest episode of Faster Forward in the Field. We're here at the iconic surroundings of BAFTA, London, where Northern Trust is hosting its annual Integrated Trading Solutions Summit. And we'd like to give our Faster Forward listeners a glimpse into what we've discussed about global trends and how those trends are impacting the investment industry. To start off, can you both briefly explain your fund and your investment process? Freddie, why don't we start with you?
Sure. So what we're looking for at Latitude is really businesses from across the world, cross sector, where we believe there's durable growth. And we're not thematic. We're not looking for the latest hot thing. We're looking for businesses that really can endure across all elements of the economy. And we're trying to build a portfolio that's really quite diversified across the 2025 stocks we own. And we're really focused on valuation. So we're using the market cycles to invest when things are out of favor and then own them for 5, 10, 15 years until they're expensive.
Got it. So you're considered a value manager
These days.
Is right. Stephen, where are you? How do you go about your job, your craft?
Yeah, so we run a global mandate with about 35 stocks, and we do all the research in-house. I think what people would probably categorize us as it will be quality growth. We do have a bias towards a company that are of high quality, company that can actually grow or take market share. But I think what's really important to us is like company that can actually outperform rather than underperform, because even within any approaches, including ourselves, quality growth, that you can ended up investing too many into underperformance. So I think that what we try to do, and of course, then we back that up with research, with financial modeling, with forecasts, with free cash flow yield, kind of valuation metrics, etc. And we just try to do our best and try to pick the best company globally. And just because we only have space for about 25 to 35 names.
Got it. And Freddie, I've heard you've been defined by others as a quality growth investor as well. So there is some similarities, even though others might see you in different buckets. But you both are active investors, which means you are trying to find the needle in the haystack. What do you say to allocators as to why they should invest in active managers? Is it simply that you have a good track record in finding the needle, or is there something else? So you said.
I think what's really important to our industry, definitely for us as a boutique managers, is that we need to demonstrate the value proposition, right? Like I think at the moment, the alternative being investing into passive with very low fee and have done better than majority of active funds. I think it's very important for us to demonstrate why people might consider us. And ultimately, I think it's one of those big trends that we probably cannot change. I mean, we just have to accept that majority of funds going forward in the market would be investing into passive rather than active. But what I'm actually seeing over time is that the market is probably going to be a lot more efficient. And if we're still here, like let's say in 5 to 10 years, I think there's a lot of value add that active managers can do to deliver, just because like passive is not the smartest strategy. I would say it's pretty smart in terms of the rebalancing, in terms of the opportunity that trying to scale up and scale down accordingly. But it's not active in a way that I think if we can demonstrate that we can outperform or do better at a slightly higher fees, net of all fees. Outperformance is very important over a reasonable period of time.
Over a long, yeah. And Freddie, is that a similar approach?
Very much so. But you've got to outperform whatever you're doing in our active space, otherwise you don't justify your existence. So I think that's absolutely key. I think the reason why right now passives might be a little bit more dangerous is because of their own success. They're brilliant investment vehicles. They're less expensive than seed and life others. But they're very concentrated now. I would argue the US market is very overvalued in many senses. And if we do get a little bit more uncertainty, which we're already seeing, the potential for relative outperformance against a market cap weighted index today is incredibly wide. We're 10s, 20s of percent from just running different strategies, let alone the potential that we would argue we have from single stock selection.
Which leads to the next question quite nicely. It's been difficult to outperform the market over the past several years because of the concentration of global indices of US technology. The question, therefore, is, has the ascendancy, particularly AI-related stocks and sectors, has that perhaps reached a point where to assume similar growth trajectory like we've seen the last 5 years now is very unlikely? And if so, where else should we be looking?
No.
Pretty constantly.
So I don't know what's going to play out with the AI story. It's huge. There's an enormous amount of capital intensity that's been going in, $500 trillion, including various other bits that you might include. So these businesses are going far more capital intensive around what I would consider a very uncertain future. It may be brilliant and it may be fantastic for all sorts of businesses, but we don't invest in uncertainty. We invest in durability. And so when we see the valuations of those stocks trading at multiples of other businesses, which we can find, which we also think will grow nicely over the next 5, 10, 20 years, we have a strong preference for those and have almost nothing in technology at the moment.
And Stephen, despite what Freddie said, you're still finding stocks exposed to those things that aren't expensive. Nvidia, for example, doesn't look as crazily expensive as some of the other technology stocks. Is that a fair observation?
Yeah, I think it's quite interesting obviously we still have Nvidia in our fund, we probably have liked the shares a lot more over the last few months compared to, let's say, sometime last year.
Because
it's come down in valuation. Of course, I think the biggest debate, which is an AI topic, is whether you do believe AI is going to change the world, right? Like, it's a very strong belief of mine or my team that we do believe AI is going to change up the world in a way that's similar to digital transformations. And of course, the frictional forces to make it very entrenched or adoptable or having the penetration is a lot easier than a lot of other things, just because it's all happened in the virtual world in terms of data analytics, etc. And so if you do believe in that, then yeah, NVIDIA will still have a role to play in the portfolio. And if you don't believe in it, then you shouldn't.
Yeah. That's a good place to end it. So what I'm hearing is AI is going to be as big a thing as Victorian plumbing. I think up until now, the loo has been the greatest game changer for productivity the world's ever seen, up until very recently, which is AI. So a good place to end us. I'd like to thank you both for sharing your thoughts and your expertise, and to you, our listeners, thank you for checking in to Faster Forward in the Field from Northern Trust Asset Servicing. Thank you.